Welcome. So, if you've ever looked at a company's financial reports and wondered, where do these numbers even come from? Well, you are in exactly the right place. Today, we're pulling back the curtain and going right to the very beginning, to what is arguably the single most important book in all of accounting, the journal. The best way to think of it, it's literally the financial diary for any business. All right, let's get into it. Just think about it for a second. Every day, a business is a flurry of activity. It's buying things, selling things, paying bills, getting paid. How on earth do you keep track of all that chaos without missing a single detail and, this is key, making sure it's all in the right order? That's the big puzzle of bookkeeping, and the solution is actually beautifully simple. So here's our roadmap for this explainer. First, we'll talk about what the journal actually is and why it's called the Book of First Entry. Then we're going to break down its structure into 5 really simple columns. After that, I'm going to show you a little secret, a 3-step method for analyzing any transaction you can think of. And finally, we'll put it all together and walk through some real-world examples. Right, Section 1, the Book of First Entry. Now, this isn't just some catchy nickname. It perfectly describes the journal's job. It is the absolute, undeniable starting point for every piece of financial data in a company. So what is it, really? A journal is just a log, a day-by-day record of every single financial thing that happens. And the most important part is that it's chronological. What happened on Monday gets written down before what happened on Tuesday. Simple as that. And for every single transaction, it captures both sides of the story. For every action, there's a reaction. In business, for every get, there's a give. In accounting speak, we just call that debit and credit. And here's a cool little fact that makes this all click into place. The name itself tells you everything you need to know. Jour is a French word for day. So a journal is literally a daily book. It completely demystifies the term, right? It's not some scary, complex thing. It's just a daily diary of what's going on with the money. And you've got to understand this flow to see the whole picture. Every single transaction begins its life right here in the journal. That is why it's called the Book of Prime Entry or Original Entry. From the journal, all that information gets sorted and organized into the next book called the ledger. And only after that can you create the final reports, like a profit and loss statement. The journal is always step 1. So we know the why. Now let's get into the how. Section 2 is all about the symbol blueprint, that 5-column structure that makes up every single entry in the journal. Now, it might look a little official, but it's incredibly logical when you break it down. Column 1 is just the dates. Easy. Column 2, particulars, is where the magic happens. You write down the names of the accounts involved and add a short sentence, we call it a narration, explaining what happened. Column 3, LF, stands for ledger folio. Think of it like a page number or a signpost. It tells you, hey, this line item was later copied to page 5 of the ledger. It's all about leaving a clear trail. And finally, columns 4 and 5 are for the money, 1 for the debit amount and 1 for the credit. And this brings us to the most important, the most fundamental, the absolute golden rule of all bookkeeping. For every single entry you make, the number you put in the debit column must be exactly the same as the number in the credit column, every single time, no exceptions. This is the law that keeps the entire system perfectly in balance. Okay, so we know what the layout looks like, but how do you actually decide which account gets debited and which one gets credited? Well, that's where this next part comes in. This is the secret code, the repeatable, foolproof method to get it right every single time. It's just a simple 3-step process. First, you look at the transaction and figure out which 2 accounts are involved. Second, you classify each of those accounts. Are they real, personal, or nominal? Don't worry, we'll cover what those mean. And third, you just apply the correct rule for that type of account to know which to debit and which to credit. Identify, classify, apply. That's the whole game. And here they are, the rules of the road. Let's make this super simple. Real accounts are your actual assets, things you can touch like cash or inventory. The rule, debit what comes in, credit what goes out. Easy. Personal accounts are for people or other businesses, your customers, your suppliers. The rule here, debit the receiver, credit the giver. Finally, nominal accounts are for tracking your income and expenses, things like sales revenue or rent. For these, you debit all your expenses and losses, and you credit all your incomes and gains. That's it. Those are the golden rules. Theory is one thing, but seeing it in action is what makes it stick. So, in our final section, we're going to take that three-step method and apply it to a couple of common business transactions. You're about to see just how systematic this all is. All right, here we go. Our first example, and it's a classic. The business bought some goods and it paid $5,000 in cash. Let's break it down using our system.
See how this works? Step 1. Identify. What's involved here? Well, we have goods and we have cash. Step 2. Classify. What are they? They're both physical things, assets we can touch, so they are both real accounts. Step 3. Apply the rule for real accounts. And what was that rule? Debit what comes in, credit what goes out. The goods came into the business, so we debit them. The cash went out of the business, so we credit it. Perfect.
And boom, here's what it looks like as a finished journal entry. Our analysis translates directly into this format. The goods account is debited for $5,000. The cash account is credited for $5,000. And notice that little explanation in brackets at the bottom, the narration. The debits equal the credits. It's clean, it's balanced, it's perfect. Okay, let's try another one. But let's add a little twist. This time, the business sold goods, but it didn't get cash right away. It sold them on credit to a customer named Ajay. Let's run the playbook again. Step 1, identify. The two accounts here are Ajay and the goods that were sold. Step 2, classify. This is different. Ajay is a person, which makes him a personal account. The goods are still a physical thing, so that's a real account. Step 3, apply the rules. For the personal account, Ajay, he is the receiver of the goods, so we debit the receiver. For the real account, the goods are going out of the business, so we credit what goes out. And once again, look at that. The analysis flows perfectly into the journal. Ajay's account gets the debit because he's the receiver. The sales account gets the credit because the goods went out. The amounts match, the narration tells the story, and the books are balanced. See? The three-step method just works, every time. So, let's wrap this all up. What are the big things you need to remember? 1. The journal is the book of first entry. 2. Everything is always in date order. 3. Every transaction has two sides, a debit and a credit. 4. The golden rule. Those debits and credits must always be equal. 5. Your secret weapon is the three-step method. Identify, classify, apply. And finally, always add that little narration to explain what happened. We've covered the what, the why, and the how. You can see this system is designed to build a perfect day-by-day financial story. So the only question left for you is, what's the first sentence, the first chapter in your business's financial diary? Is it the owner putting in some startup cash? The first time you buy equipment? Now you've got the tools to record it properly?